Today we're trying something a little different on the channel, and this is going to be a live interview with a real business owner to talk through real financial statements with a real financial problem, okay? This business that we're gonna talk to today, the owner is actually struggling with some profitability. I know that she is not alone in this challenge that she currently has, and so we're gonna look at 2022 financials and Q1 of 2023, and we're gonna talk through how to improve profitability for this business. And so if that is interesting, please stay tuned, and we're gonna get into it in just a second. If you aren't already subscribed to the channel, we'd love to have you here, so please subscribe. All right, let's go. All right, well, today we have something very exciting. We have a live interview with a business owner, a real life business owner, and I'm excited to talk to her today because we've got a set of financials that we're gonna talk through, and we're actually going to be able to have a really great conversation together about financials and talk about some financial health of this business. So Molly, thank you for joining us today. Could you tell us a little bit about your business and maybe what prompted you to reach out to me to look at your financials?
Hi, Hannah. Thank you for having me today. We're excited as well. We are what we call a handyman business.
Okay.
We work for HOA companies. We are on many vendor lists. So we have 150 properties, et cetera, that we go. A community manager might send us a work order or a big request, and then we go and do the work. So it consists of gutters and siding and painting and that kind of work. So we wanted to reach out today because we have been a very successful business for many years. And then, of course, as you know, what happened?
Mm-hmm.
Things got rough on everyone. So that being said, I'm not completely surprised, but I am a little bit surprised that year 3 of this is the worst year. What I believe is happening is that nobody wants to work anymore, and that is certainly not a new subject. And especially in this kind of work, we went to another business and we just pulled some employees right off the floor and asked them, and they said they were making what we pay, and all they have to do is stand around all day. And so the competition to get workers is difficult, especially when we are a labor extensive job, and that takes a lot of work. And so I don't know if that's the issue completely, but I'm hoping at looking at our financials, so at least we can square in office so that we can be doing the best job we can be doing. So
Okay, that gives us some good things to talk about. So maybe you could tell me a little bit about, and I'm just going to go ahead and pull up the financials because this is a good sized business. So just to kind of give people context, this is a business that was making in 2022 just under $1 million, so really high 6 figures. Is that about the volume that you were doing pre-COVID too, Molly?
Definitely.
Okay. Has it been pretty...
Sometimes even a little more.
Okay, gotcha. And then tell me a little bit about, I'm going to move this video around here. Tell me a little bit about the different types of revenue or contracts that you have. Like, tell us how people engage with you and how you get paid. Are they long-term contracts? Are they just, spot jobs? Those, the HOAs that you're working with, how are you structuring that?
The kind of contract work we do is only in the sense that we send out estimates and they sign them. We rarely have contractual work where they're sending us contracts. So again, as I said before, it's a smaller job, lots of smaller jobs. And then we engage subcontractors to do larger jobs that we can't handle on our own, such as painting an entire community, or if we have plumbing or electricity or things that we're not certified to do.
So do you have like retainers set up with these clients where they're paying like a small monthly amount just to have you on call every single month?
We don't.
Okay.
We have long-term relationships, 20-year relationships with the people we work with, and they basically send us work orders and we do the work.
Okay.
Or they send us estimates, and then we send them estimates, and they sign them, and then we get the work done. We also do progress billing, so that they have to pay incrementally as we complete the work.
Do you take prepayments or deposits on work?
We do 50% deposits on anything. Generally, our rule of thumb is over $1,000. We do a deposit payment.
Okay.
Of 50%.
That's great. I like hearing that because that will significantly help with cash flow. Okay, that's good. Do you do anything direct to consumer? I guess more residential, or is everything more? I guess like would it be like for an individual homeowner, or do you only work for HOA organizations or like apartment buildings and things like that? Do you have customers that are just individuals?
I do know that answer because when we get our yearly audits, we have to give that information, and so we guess approximately 2 to 3% residential.
Okay.
And the rest is HOA commercial.
Okay. And is that mostly because is it more lucrative for you to do that, or is it, those are the established relationships? Why is that the case?
So it is more lucrative because we're dealing with established businesses, mm-hmm. and they pay their bills. Mm-hmm. Also, we get the residential referrals from those exact HOAs. People will see us on the property and they'll pull us aside and say, can you do this for me? Mm. Or oftentimes an HOA in their bylaws, they're responsible for a certain amount, but then the customer is responsible for a certain amount. And say we're doing a patio, the HOA might be responsible for part of the patio, like the caissons or the columns, but the resident might be responsible for another part of the patio. So then sometimes we'll do a combined. We'll do part of the contract with the HOA and part with the resident. So that's how we've come by our residential. We don't generally do residential, but it's just a byproduct of the job.
Okay. Yeah, that makes sense. I can understand that. So you're not like targeting residential. Okay. I think this is a great foundation to start looking at revenue. So when we look at last year, so I'll pull the full year so we can get it all on screen here. So everything is lumped together in construction revenue. Do you think that there's more like subcategories of the different types of work that you're doing, or do you think it really all just goes into this general handyman services? I think it could be broken down.
It does go into that.
Okay.
I'm not sure it would be profitable to break it down. We do some internal spreadsheeting where we typically in the December, January, we're slow. Mm-hmm. So in the fall, starting in September, we start a campaign of gutter cleaning, and we revisit, and that holds us through all the winter because we can't even start till the leaves fall, obviously. Mm-hmm. So we have some things like that we break down separately in a spreadsheet just so that we can track some of those jobs to keep us busy. And I'm going to start doing that with the paint jobs as well.
Oh, okay. Yeah, I kind of like that. Now is it QuickBooks Desktop for your accounting right now?
Yes, we are. We've had it so long, and we actually use Enterprise. So it would hurt to change to online. Yeah. And I know I'm probably going to have to do it someday, but it doesn't sound fun to me.
Yeah. Yeah. I mean, it's gotten a lot easier to switch over. It's totally fine if you do. I'm just thinking like how you're invoicing. So are you invoicing out of QuickBooks as well?
Yeah.
Okay. If you the only thing I'm thinking that it might be nice to break out on your estimates and invoices to clients, do you currently do you have a line item for materials versus labor, or is it all lumped together into one income item?
For now, it's actually LBR/M. It's labor materials. The only time we break it out is if they request it.
Okay.
And that was on the advice of those who've gone before.
Yeah.
So
yeah, I can understand. Like if you're having like a markup on materials and people want to see receipts and stuff, I can understand that. But if you're not separating it out on your invoices, then obviously we can't do that on the income statement.
Yes, so. We don't. We're the kind of business that, from what I understand, some businesses don't get charged tax when they purchase their materials, so then they forward that on to their customers, but we pay the taxes as we buy our materials, so we don't have to separate that out the same way as some businesses do.
Okay. Well, because I'm looking here, so it looks like total materials, are about 16% of labor. Total revenue. So that's a significant amount of what you're spending money on. So I think I was just first thinking, okay, let's make sure that all costs are actually being recouped from customers in that way. And also like materials have gone up so much through this, COVID period. So I would imagine that if we looked at more historicals, that your materials could be potentially a lower percentage of your total expenses than they are now. So
what do you normally what do you normally recommend for that percentage?
I don't think that there is a standard for this. What we'd be looking at more is like total gross profit. So everything that goes in, I would want to see gross profit for a business like yours, and you have labor up in here, to be 50% or less. So we'll do that calculation in a little bit, but that would be a combination of materials plus also the labor in your case. So we'll go through a couple of these things because I think this is kind of interesting. But I do think that this could be a place that you've had some expense creep. And so making sure that you're also pricing for that creep. I'm sure you guys have noticed those costs going up. So that could be one place that it's eating into the margin that you used to have. So it's something to just look into there. So, other things that you're spending money on, little supplies here and there. This is not a big line item. I don't, that's just going to happen. Equipment rental, you're not doing tons of equipment rental. If this was super high, we would be maybe discussing, are there equipment items that we need to be purchasing rather than renting, if that would make more sense over time. And then you also have like small tools and equipment, things like that. None of this is super big. So I would like you to talk to me a little bit though about subcontractor expense, because I was surprised to see, knowing that yes, you do, like in a labor type business, you are going to have a lot of subcontractors, more than maybe another business, but this is 25% basically of your total revenue, which I find very high. I would like to hear when you're using subcontractors and how, tell me a little bit about your use of subcontractors.
Sure. And I also would like to maybe add into the fact that this is one of my main concerns as well, because it's almost opposite of what you're saying. We actually do better the more subcontractors we use. And the reasoning behind that is because if you think about it, if a subcontractor can be doing the work, all of our guys are free to continue doing other work. We only pay the subcontractor a portion of what we build. So we make money off the subcontractor and our guys at the same time. So this is one of the areas where I feel like the pandemic slowed this down, because people stopped painting their communities because they didn't have money. And they stopped doing siding jobs because they didn't have money. So where that might be concerning, I don't think it's as concerning for me. But as far as to answer your question, subcontractors, we use them for painting. We use them for larger concrete jobs that we're not able to do because they have all the equipment. We use them for electrician work because we're not certified for, we can do repairs, but we can't do installations and whatnot. I'm trying to think of what else we use them for. Let me just look very quickly and I'll tell you the rest. We have a guy that paints stripes on parking lots for us. He's got all the equipment. Mud jacker, and I think that's about it.
Okay.
We don't use a lot of subcontractors, but when we get a lot of paint jobs in the summers, that really helps our business.
Okay. So maybe let's look a little bit at revenue. So last year you had some spikes of revenue like in May and then June and August. Do you remember if those were related to some of these larger projects?
Well, they are, and they're also seasonally related. Obviously, when you're a handyman business, almost all your work is outside. So you don't get the rain days and the snow days. And we engineer our bidding processes to schedule those jobs in those months. So even if an estimate is awarded in January or February, it's set for the either late spring or summer. So we're always going to have that.
Okay. All right. And then what's the markup that you're typically doing on a subcontractor job if you're just totally outsourcing it to somebody else? Are you able to mark that up?
That's a good question. That's a good question. I don't do that part, but I do know that typically the rule of thumb that I've heard is that all expenses plus, 35%.
Okay.
So vendors, subcontractors, and the 35% would cover, profit plus office expenses.
Yeah.
So.
Yeah, I think that's pretty healthy. So essentially you're acting more as like almost project management on the jobs then, that these HOAs are coming to you guys just to get it taken care of. You have your preferred vendors you like to work with. And so you're making that process smoother for them, correct?
Correct.
Okay. Yeah. I think that's a huge opportunity. I can see that, like, if you're developing relationships with these subcontractors, lowers the labor burden that you have yourself, and then you don't have to be a specialist in all these other things. So I do see that that could be a good opportunity. That makes sense to me. You might want to look just over time and see, like, if you're consistently getting certain jobs over and over and over again, then does it make sense to build out your own labor team? Let's say for like painting or something, where it's more about having the laborers and less about having the big equipment and the big investments. You could look at that over time and just see, like, how much are we actually selling over and over and over again of these services? And where does it make sense to grow the team? Or do you need to have an electrician that's on your side? Because when you are paying contractors, you are paying for their, labor and their profit and their markups. So you are paying more than if you had somebody internally to do it, but you need to have enough labor coming in or enough work coming in to keep that person busy and make it sense for them. So I always like to look at like this kind of thing, like, do a look back and see, like, who did you pay the most over the prior year? If you paid one company, $100,000 during the year, what were they doing for you? And see if it makes sense to hire somebody for, $50,000, $60,000, $75,000 a year that you could potentially produce more revenue from them. So it's just good to like keep that in mind. And I'm sure you guys are thinking about that, but otherwise I could see just the opportunities for making sure that you're maintaining relationships with these subcontractors and building out your portfolio of, people that like and trust, and that you would give, work to any day of the week, that are going to do a great job for your clients or for your customers. So it sounds like you are doing that, which is great. So tell me a little bit about carpentry wages and then building and maintenance wages, because those are my next two questions. Like, how are you breaking out these two things?
Sure. So those kind of were born out of audits. So when our auditor comes,
can I ask you real quick, like, what you're getting audited for?
Our insurances.
Okay, like workers' comp?
We have liability audits, and we have workers' comp,
okay,
and we have even a health insurance audit. So
okay.
That being said, that's how they are. So a workers' comp would come and they would say, how are you breaking these down? And they put us through this barrage of questioning. And this is what we came up with. It's possible that they might actually want more breakdown, but they've agreed to keep it as minimal as possible. So carpentry would be anything that cuts wood, basically. And so if you were doing siding, it would be carpentry. If you would do fixing trim on a house, it would be carpentry. Mm-hmm. If you would be building a deck. But there's other ones that fall under maintenance, and that is most of our work. If you're fixing a gutter, if you're fixing a fence, it's not touching the house. If you're, doing a metal handrail, that's not carpentry. So we've just broken it out according to their parameters.
Okay, that is good. And so are any owner wages in either of these?
Yes, I think. Well, our owner wages are a reasonable amount on payroll and then an additional draw. Mm-hmm. So to be fair,
yeah.
So we pay our owner the right way.
Yes, because you are you at S Corporation, taxed as an S Corp?
We are.
Okay, great.
We are, and so I do believe some of his is in there, yes.
Okay, and then I think there's also office wages down here. Yeah. So that's also, okay. So I'm going to highlight anything that is wages or payroll so we can do a calculation here in a little bit. Okay. All right, so we've got... Oops, just seeing what this is as a percentage of, okay, so that's 31.5% as a percentage of revenue. Okay, and then when we get down to gross profit, okay, 21%. Doing some calculations here, trying to get some percentages so we can see. Okay, so 80% of revenue was spent to just do the work. I can see why the last year was not profitable then in this case. So when we look at the total year end, it was basically a break-even year. So just a teeny tiny loss for the year. So ideally, what we would be wanting to see is that this is more of the margins that we'd like to see from like total expenses, and then profit closer to 20% for a service-based business like yours. So basically what this is kind of telling me at this point is that you don't have enough income, or expenses are too high to cover everything else, all the overhead. Now your overhead is not crazy high comparatively. So, I mean, we're talking on average about 15,000. Sorry, I keep having to move my Zoom thing around. About 16,000 per month for just overhead expenses. So that's going to be some office wages. That's all you have your payroll taxes down here instead of up in cost of goods sold with the wages. There's not a lot of other things. You do have your rent, utilities, things like that, but most everything is attributed to cost of goods sold up here. So what this is kind of telling me, the story that these numbers are telling me right now, is that we might have either a pricing problem. I'm going to be leaning towards a pricing problem on these projects, that maybe not enough is being factored in, or there's not enough margin being worked into these estimates, because it seems like they're just enough to cover our costs right now. We could look at cutting costs, but I hear you saying that people are wanting to be paid more right now because of the labor challenges that we're having. And then also, if we can, sell more work, we can just hire in subcontractors to do this. So what do you think about the pricing, I guess, theory right now that we have, that it might be looking like jobs might be priced a little bit too low?
It's interesting because knowing that 35% is factored in, I don't do the pricing, but I do know we have run into several jobs we've actually lost because people are coming in underneath us. And so that also complicates things, because ideally what you're saying is that we should actually be charging more. And I do understand the marketing business of, if you don't charge enough, they don't value enough. So I'm not sure we would lose more if we charged more, but we have already, and I don't know if it's larger paint companies coming in behind us, underbidding us, or if it's, because small businesses do suffer that way. Yeah. So yeah, and I can agree with you, but I would have to have more consultation with him to see, what his current buffer is, profit margin, et cetera.
Yeah, I mean, I 100% understand, especially in the physical labor trade space, there's always going to be the people who are going to underbid. And then you also know that there's a lot of people running businesses that are actually not profitable. And there's a lot of people running businesses that they can't actually stay in business for a long period of time because they're actually just losing money. There's a lot of people that will, say they can do things for less. But I think one of the interesting things about what you guys are doing, and this is maybe a positioning and maybe even more of like a branding and bigger picture, I guess, issue here, is we need to be thinking about the value that you're really providing to your customer, and that you're not just providing painting services. You're actually providing something that's much more holistic, because HOAs or different organizations are coming to you looking for you to fix their problem, and they're looking to have it outsourced and taken care of, and that, they know they don't have to do all the vetting of the individuals, and they know they're not going to have to deal with the day-to-day project management of it. So you're actually selling something more than painting services. So when we get to that, it might be more of a positioning and a sales conversation, more so than just a, hey, we're getting 3 estimates for painting. One of them is from your company and 2 of them are from painting companies, because you're not really selling apples to apples, Does that make sense?
It does. And I find it interesting because one of the shifts that happened during COVID was that community managers, they work for management companies, right? And so they work for a big management company, and then that management company assigns them, 6 or 7 properties, and they analyze those properties to see what work needs to be done. But as COVID progressed, they weren't getting out. And at that point, then our manager had to start walking these properties just to get the work because they were staying home. They were working from home. And that was a terrible setback for us because now our manager that was able to manage now is doing the community manager's work for them, and we're not getting paid. We're just getting the work. So that could be a little bit of some of the expense.
I see that as an opportunity. And I wonder if, because part of me thinks that you have the opportunity for a recurring revenue stream here, that you could be potentially bringing in something that you're selling a monitoring service, or a, you know, if you need that person that's going to go out and actually walk the properties, like you're saying, we will monitor your properties, or we will do a monthly walkthrough, or we will do something that becomes like a monthly recurring revenue stream. Even this is, I mean, we could talk, we won't have time to talk about pricing today, but even if it was something as simple as like $500 a month or something, but if you took $500 a month and you multiply that times 150 customers that you have, you could potentially be building in something that's like, hey, first of all, we know you, we're developing that relationship. Hey, we're also, you know, keeping an eye out on things for you. And like, you're going to be, you know, top of our list when somebody calls. We're going to be, you know, talking to the people who are on our recurring, you know, maintenance program before we talk to, you know, and get bids out from new people. So I think there's an opportunity there to maybe just kind of have some kind of underlying level of value that customers could be getting from you that also can create that recurring, you know, revenue. Do you think there's something like that there?
We actually do some of that already. Mm-hmm. It's more specific, and like we'll do a trash walk. So we walk the property twice a week, and we pick up trash for them. Mm-hmm. While we're on the property, we also look for other jobs that need to be done. Some of the restrictions in that might be just the specific board, because every HOA property has a board, and some want it, some don't. But I mean, that is certainly something that we do, and it's certainly something that we can do. But also, revisiting the fact that we're having trouble finding workers. Mm-hmm. If we have to schedule our workers for a gutter job over here, and then all of a sudden they are restricted because twice a week they have to be over here walking properties, and you'd have to have several crews to walk that many properties. But I like the idea, and I'm with you, and we do some of that, and we could certainly expand on that. We do have restrictions as to whether or not that will work for each property.
Yeah, I can understand that for sure. So just to kind of, I guess, like hypothetically, if you were able to, let's say, sell something for $299 a month to these people, to these HOAs, and they get a certain amount of services. So it's not like that's just, you know, nothing. It's not just to be on your list, right? It's something, you're doing something for them. And you have 150 customers, that could be $45,000 of revenue every single month coming in. That could absolutely, you know, you could find somebody to come in and be like that position, you know, or maybe even two people that are that position, and they do some of those recurring items for you, bringing in another $500,000 of revenue, you know. And in that situation, you are, and we're not including extra labor, obviously here, there would be extra labor you would need to have, but I think there's a value here of what do these HOAs really want? What do your customers really want? They want their neighborhoods to look nice. They want their apartment buildings to look nice. They want to make sure that there's not deferred maintenance and there's not sneaky stuff that come up. And, you know, and when something does come up, they want to get it fixed quickly, and they want to have a reliable, you know, they want to have somebody reliable there. So I think there's something here. We're not going to solve it today, but I would like that to be maybe one of the major takeaways of today, to think about like, what could that look like for your company? Obviously could definitely solve the cash flow concerns of, you know, seasonality. But it could also, I mean, it will increase the value of your business significantly, having monthly recurring revenue. And then it gives you that opportunity to identify more and more projects that you could be doing for them.
Yeah, I like that. My intent is to revisit this video with the GM and really go over this and listen to it several times so that we can wrap our head around it more clearly rather than just the first visit. So That sounds exciting to me.
Yeah, it's exciting to me. I love recurring revenue. It's always a good thing. It does wonders for your finances. Okay, other things I want to point out here. So, like I said, I would like to see this total COGS number being 50% or lower. So this is kind of throwing off, a lot of your ratios right now, because you do have, these high labor costs, and because I think we're missing out on some revenue opportunities here. Other things, as I was looking through your finances, I didn't get tons of time to look at them before this call, but you really don't have tons of other overhead expenses. You do have some insurance. Obviously, insurance is very important in the work that you're doing, and being insured and being able to prove that is absolutely imperative. I like that you've got some employee medical insurance in here. I won't get into this like personal purchases so much, but I would be questioning why there's so much personal purchases. I don't want to take a lot of time on it because it's not a lot of dollars. And then
I could explain that a little bit, that they do. That is just to record if somebody accidentally uses our work credit card instead of their regular credit card. They do reimburse all of that. So.
Okay, great. So it's kind of evening out over time.
Mm-hmm.
We sometimes see people do that on the balance sheet, like put it as an employee liability, but as long as it's netting out, like I see it's kind of netting out here, you can record it that way. I did notice that payroll taxes are all lumped together down here in G&A expenses or other operating expenses. So the portion of payroll taxes related to these carpentry wages and building wages aren't included in cost of goods sold. So I think that's just something to remember when you're looking at your totals.
I heard you say that on another video one time, and I'm not really sure the difference. This is how it was set up when I came here,
okay.
And it's how QuickBooks sets it up when you set up your company. So I'd be more interested in hearing a little bit more about that later.
Okay.
Later time.
Yeah, and I mean, since you've got carpentry wages and building wages up here, we'd like to have the payroll taxes related to those also included up there, so you can see your total labor costs. But it kind of depends on the sophistication of your payroll system and if you can even do that. So if you can't,
I might be able to, and I could touch base with my CPA as well to get that.
Okay.
How I could divide it out.
If it's kind of a one and done setup, I think it's worthwhile to separate those out. But if it's not, then just keep it in mind when you're analyzing your financials. It does look like you have an office building or something renting for space. Is that for just, is that any storage, or tell me a little bit about the office space?
Yes, we have 2 offices, 4 desks. So each office has 2 desks, and then we have a warehouse space.
Okay. And that's all included in the rent?
Yes, it is.
Oh, okay. That seems pretty reasonable, especially for extra warehouse space. And then office wages, obviously, we've got some admin support. And, really, you're not spending a lot of money on extra stuff. I mean, I imagine phones are very important in the work that you're doing, so your telephone expense is a little high. And then obviously utilities for the space, but you're not spending tons on software. You're not spending a lot of extra besides your people and then just getting the job done. So, I mean, overall, I say the extra expenses, it doesn't look like there's a lot you can cut there, because sometimes when we have problems with profitability, we need to say, is it a revenue problem or is it an expense problem? And so I'm seeing potentially that it's more on a revenue side. A lot of your expenses is wrapped up in wages, so we could, dive into that a lot deeper and see if there's any wasted time there. But I'm really seeing that I think there's more on the table on the revenue side than maybe what we're really getting at. So I want to go through a couple metrics. We're going to look at the balance sheet real quick. It looks like you're doing profit first with your bank accounts. Is that right?
I guess I'm not following the question. I don't know what that means.
Okay. These different bank account setup, this is kind of a classic. There's a book called Profit First, and like separating money into these different accounts for different things is kind of like called a profit first system or something. But it does look like
we do this. Go ahead. I'm sorry. I was just going to say that we separate them out so that we don't rob Peter to pay Paul, basically.
Yes. Yeah, and that's kind of the concept of the profit first system too. So sometimes people will be surprised to see so many bank accounts, but a lot of that is just means like, okay, we've got this money set aside for taxes, we've got this money set aside for job deposits, which I think is really smart, knowing that that's going to specific jobs. And then you've got a savings account. So overall, cash is pretty healthy at $175,000. And this is at the end of last year. The balance sheet for March is a little bit lower, burned through a little bit of cash. But overall, we've got some trucks, equipment, things like that makes sense for the type of business that you're in. Minimal credit cards, I'm really liking to see that, not a lot of debt on the credit cards, which means that you're paying things off in time. And then also really not any liabilities. You had the PPP loan, paid that back. This could be wiped off your balance sheet at this point in time, but really healthy on the liability side. So I was liking to see that as well. I'm actually just going to go straight to my metrics tab because I want to talk through a couple of things that we're going to be looking at. Profit percentage, these are kind of some metrics overall that I like to gauge whether or not a business is kind of in a healthy place or what we'd like to be moving towards. So your profit percentage and I'm kind of going back and forth between Q1 and last year. Q1 was negative 10%. So we're seeing the trend from last year flow into Q1. And yes, it seems like Q1 is probably a slow time for you guys because we haven't hit the summer months yet and everything, and that will probably, bounce back up. I think Q1 of last year was also a little slow. Yeah, you guys had a loss last year as well. Actually, a bigger loss last year. So you're doing better year to date than you were last year. But when we look at some things, we'd like to see profit percentage at 15 to 20% for a service-based business like yours. I want to touch a little bit on labor efficiency ratio. And this is something that I talked about in some of my videos. And sorry, I'm going back and forth on tabs here. But labor efficiency basically means for every dollar of labor, how much revenue is it producing for you? And I have this little calculation that I put together. And this is actually not including all of the labor because I saw some more labor. I didn't get the G&A labor down here. But you basically take gross profit and divide it by labor costs. And you want to add in all your labor costs here. Actually, I'm going to insert some additional labor. And I'm probably going a little fast because I know we're running up on time here. But I do want to add in this office labor. Sorry, I don't know why I did this way over here where I can't find it. So let's go office labor. So all labor costs I put together so we can see how much you're spending on labor costs. And then what we want to do is compare that to gross profit, but I added back in the labor costs. So we're just talking about gross profit, meaning revenue minus all your materials, expenses, and everything. So when we do that, we want to make sure that every dollar of labor is producing $2 of gross profit to get our labor efficiency ratio into a good, healthy place. And what I'm seeing is that labor costs are in some cases maybe even outpacing total gross profit. So in the month of February, you had $33,000 of labor, but then $32,000 of gross profit. So that means that you definitely wouldn't be profitable in a month like that. But what we'd like to see is actually have this 2-to-1. So when you look at the full quarter, you're producing $1.16 for every dollar of labor. And that isn't where we would like to be from that labor efficiency ratio.
Could I ask a question?
Yes, absolutely.
So if it was $2, that would be the 50% profit you were talking about earlier.
Mm-hmm.
And just let me run this scenario by you real quick. If it makes sense to you, it doesn't initially sound like it makes sense, but to me, it all still is stemming back to not having enough workers. If the GM has 40 jobs he can't get to, if we have even 3 more laborers or even 2 more laborers that would work full time, he can split his crews up and do double the work. And because there's so much work on the docket, they work faster and they're not as lazy. And I'm not saying that our workers are lazy, but you can see that with the less jobs coming in, then especially the higher office rates and the higher other things, sometimes because they can't be in 2 places at once, they have to stand around between jobs because the same crew has to go from job to job. So And that is definitely something we're aware of, that that's exactly why we want more workers. And it does sound like it would drive up the labor rate, but it would incrementally increase the income.
Yeah. Well, and I think we have to be, really honest about like what will attract people to work with us. What are those things that, is it just a higher hourly wage? Is it a more of a, better, holistic work environment? I think generally like people, like variety, and the people who like variety would be really good to work with you. You need to think about really what are the reasons that people will come and work with you guys and also stay over time. And maybe that means that you need to increase like overall benefits, or you need to increase wages. And that's where like if we have that extra revenue coming in, we can help cover some of those, and then you can keep and retain really awesome employees. So I agree with you. Sometimes we are limited by the amount of people that we have to work for us, but we need to think about what is it going to take to really get those people on. And trying to get the lowest cost workers, or trying to get people who are less expensive, is probably not always the best play. I'm not hearing that you were saying that, but what is it going to take to actually get people and keep people? And that might mean that you're going to, when you have those people on, you will be able to have the revenue to cover it, as long as those jobs are priced correctly. So if they're not priced correctly, then you're going to just be working yourself into a hole. You're going to be working really, really hard to just pay people and then not have anything to show for it. So you need to make sure that the pricing is correct on that. But
I think it's interesting what you brought out, because two things. Number one, I think we're in a transition, because there are some employees that have had three raises in this year. Our company is going toward that. Maybe we were at getting the least pay possible, but we spent the last 2-3 years trying to change that. We've run this business for 15 years, but we've only owned it for 5.
Okay.
And making some of those transitions has been difficult, but we want to do that, and we want to go that way. We want to give our employees the best that they can.
Yeah.
Now that it's under our watch, and also now I can't remember what I was going to say, of course, but it was something that you said, but I can't think of it right now. So
I saw this diagram one time of comparing Costco to Walmart, with the average wages of a Costco employee versus the average wages of a Walmart employee, and all the benefits in the fully loaded package. And it talked about how retention was so much higher at Costco that it actually ended up being a lower cost of employment than, because of all the turnover that happened at Walmart. And I just thought it was a really great kind of holistic financial snapshot of, sometimes we think we're doing something by like trying to get lower cost labor, and we're trying to cut down the costs on our P&L, but the whole impact to the business is like much more. And if you talk to anybody who's worked at Walmart versus worked at Costco, like the experience is so different as well. So I think it's a good thing to just kind of keep in mind when we think about staffing our teams. And, I'm talking to you, but I'm also talking to the audience of, YouTube as well. When we really think about how we want to grow our businesses, we get to be really selective as a small business on who comes in and works with us. We want those people, hopefully when they come and they do a great job, that they stay. And turnover just costs a lot of money too. So if you could pay your employees a little bit more, that keeps them there and keeps them happy, you're going to be better off financially for the most part. So I know we didn't get into maybe where we thought all this conversation was going today, but do you have any last questions for me as we wrap up today?
No, I think what we've talked about really agrees with what I have been thinking all along. I am a little surprised about the pricing as far as it being underpriced. I am not surprised about the labor being high. But again, as we explained earlier, when there's not enough workers, it stalls out the scheduling in a strange way that makes you ineffective. So if we could have a few more laborers, and I 100% agree about paying more. And that's just a transition that we're going to have to make as a business. And in our defense, we have quite a bit. So
that's great.
We're still working as to inching into that. And what I'm hoping is that the teeter doesn't totter quicker than we can adjust. And so, but as I mentioned earlier on email, I see a healing happening already. And even though it is in the form of we're losing less money, that's still better. And we want to change and go over that hump of making a gain again. And I can see it happening. And as you could see, and people that are watching could see, we did have PPP loans. So we don't have that now, but we have been able to save a buffer back that our CPA asked us to draw out of the company in another bank account that we reserve on the side that we didn't talk about, so that we can reinvest in our own business if need be. But right now we're doing okay, and we are healing. And so I can only say that I really appreciate your insights, and I'm looking forward to implementing some of the things that you've told us.
Yeah, absolutely. Well, and I'm not sure if you got PPP. Did you look into whether or not you qualify for the employee retention tax credit?
I've talked to my CPA several times about it, and he just advised against it. So I know that there's goods and bads with it, and I just keep consulting with him on that.
Yeah. I mean, I would say there's nothing bad about it if you truly qualify for it. The only bad thing is there's a couple of bad things. The only bad thing is if you don't qualify for it and somebody tells you that you do and you get the credit. Don't do that. But if you qualify for it and you use somebody like your CPA and not one of these ERTC mills that'll charge you, 30% of a credit amount or something, and they want it up front, there's really absolutely nothing bad about it. It could just be cash in the door. So if you do qualify, I would highly recommend making sure you check that out. And because it's still open and still available. And knowing that your business could have maybe dipped a little bit, it just is like triggering in my mind, like maybe there's, since you were doing well and then there's been some dip, it's worth at least an analysis. So, and then we have a spreadsheet that you can do to do the analysis on it to see if you qualify. So you don't even have to go to the CPA for that. You could bring that to your CPA after you do some initial stuff. But worth looking into for sure. And then I really appreciate you being vulnerable too, because this is like, you're putting your numbers on display. Yes, nobody knows who you are besides Molly, but we have even made up that name for the purposes of this video. So thank you for being honest and talking through these things. And I think this will help a lot of other business owners know that, first of all, they're not alone in having some of these challenges. And then this is a very, very common problem, talking about some of these things like, labor efficiency ratio and, profit margins and gross margins. This is what we actually see. This is why we look at these metrics, because they're affecting, how you're feeling about your business, and it affects your cash flow coming home to your family and things like that. So these are really important numbers, and we're tying it all back to a real business here. So, all right, Molly, well, I'm going to let you go. Thank you so much for being my guinea pig in this video as well. I really appreciate it. And I think it's been really interesting talking to you, and definitely reach out if you have any more questions after you guys watch the recording and everything.
I will. Thank you so much, Hannah. It's always a pleasure to watch your videos, and we all learn so much, and we're all grateful for all that you do.
Thank you. All right. Well, have a good rest of your day.
You too.